In this video, traders, we're going to look at 3 biggest risks for investors. Stay tuned. Hey traders, warm welcome to you. So you investor with a portfolio, what are the biggest risks you've got to look out for? And also some supplementary ones I've added that I think are worth thinking about that potentially aren't as big as the big 3 we've got out there. Now, these are arguable. These are either ones that I think, in the comment section below if you agree or disagree with these. So the first one is pretty obvious, right? The first one is economic risks. This drives everything lower. If the economy is tanking, the global economy is tanking, the country's economy is tanking, it doesn't matter whether the stock you have is the best stock ever and it's making a load of money, it will fall. And the irony is even the defensive stocks out there will fall, they just won't fall as much as potentially some of the high beta stocks or the stocks that are leveraged up and are making loads of money in the good times and just get choked off in the bad times. So really, if you're investing in a portfolio of stocks, you need to be pretty sure the economy is going to roll on, or have a contingency plan if the economy starts to stagnate, so you're not stuck holding the bag when things go lower. Now, if you're investing for the long term, does it matter? Probably not. If you can ride out the wave and we push back up again out of the recession or out of whatever it may be, the stocks are going to recover. If you haven't got that much of a long-term view, let's say you're, about to retire or whatever it may be, then that's something we've got to be a little bit more cautious about. Okay, so economic risk driving everything low. Biggest one, we've got to watch out for that. Okay, number 2, market perception. We forget that actually, even though company valuation does drive stock prices, right? We know that if the company's making money, the stock price is going to go higher, generally speaking. But there's a perception of how the market, the street, the public, whoever other investors perceive the company. The company could be making okay money, but if people were like, hey, you know what? They've got no future. They've got no expansion plans, that stock is going to stagnate. Or you can compare it to another company that's perhaps losing money, but they've got a good story, they've got a good management team, they've got a good kind of 20-year plan that could be soaring. So it's tricky sometimes to go where the money flow is going. Sometimes it's a solid stock, but it's just not making you the returns you want because other people are chasing after something that's more exciting. Public money's moving around into some sort of technology and you're kind of investing in retail, which perhaps is stagnating, or whatever the case may be. The important thing is it's not just about the company, the value of the company, etc. You're really trading or buying against the other people believing that that's going to be a good investment and still going to be a good investment. So watching out for market perception. And that's true as well for whether we're investing in stocks that are making good money and also the stocks that are struggling. We might buy and invest in a stock that's really, as Warren Buffett would say, on the operating table is the best time to buy it. So, it's about to die. We invest in it now. Not necessarily the turnaround is there, but has to be combined with other investors, other funds believing there is a turnaround and starting to buy that. And if timed right, you can double your money very, very quickly and then be on board a potential change in trend. So market perception is very, very key. If that changes against you, you've got to be cautious. Right, number 3. This is a real personal attribute. If you're too risky or too cautious, there's potentially huge risk in your portfolio. Obviously, the being too risky, we get that. If we're piled in too aggressively into one specific stock that's a high risk stock, a small kind of bit of bad news can see that thing halve or whatever it may be. For example, in some sort of biotech stock, unlikely perhaps for a long term, but let's say you are, and it's had a great ruling, all of a sudden they have some kind of results that indicate that their flagship drug is ineffective. That company is going to just be 50% lower the next day. So there's that appetite for risk, and there's whether you're spreading your risk across different sectors, across different stocks. But that's pretty obvious, right? The other one that's not so obvious is this, being too cautious, because being too cautious could be, being in stocks that are really not going anywhere, buying stuff that's really too safe, and then really you're not getting the upside when things are good, but you're probably gonna get the downside when things are bad because you're in these very safe stuff, and yes, they may not get hit as bad, but the economy turns, you're not getting that many multiples when the market is running. So it's a fine line, I get it, you can't be too risky on one thing, but finding that balance Very personal attribute, this, to discover whether you're too risky, too conservative, and just trying to find that sweet spot so that you dial on risk where it's prudent to take it and you dial it back when it's prudent to be a bit more conservative. The other things to think about, guys, are obviously, political risk. You've got changes in government or change in legislation, all that kind of stuff. And actually, that's what that one there. That can be sweeping. That can change things in an instant. You look at US steel, for example, on the upside of that. Inflation, inflation is rising. Generally, people may push away into kind of inflation hedges like gold, etc. Fraud, are not likely, but we've seen big companies brought down by internal fraud. Competition. Companies who think they're doing well and are quite smug and are quite content, and yes, they're making money. All of a sudden, an incumbent comes in. They don't think it's worth that much. Blockbuster Netflix is a great example. All of a sudden, the tables are turned and these guys go out of business. So watching out for that. And over trading. Going back into this personal attributes thing, just churning too much, flipping your portfolio around, buying something, holding it, changing your mind, not sticking out for the long term. Investing, completely different to trading. Trading's all about grabbing that momentum, that 3 or 4 day momentum if you're swinging from that perspective. Investing is believing that company's going to be more valuable in the next 5 years, 10 years, 15 years, whatever it may be. And so churning in and out of stuff isn't conducive for long term. If you find yourself doing that, then maybe you consider a short term approach and have different criteria for it. So anyway, guys, 3 biggest risks for investors: economic risks, market perception, and being personally too cautious or too risky. Whatever you're out doing in the markets, take care. See you in the next one. Bye-bye.